Imagine this. You're watching your account climb, $500, 1,000, 2,000. Your heart's racing. This is it, the trade that finally proves you're not just another retail trader. But within minutes, that green turns blood red. Stop hit, money gone. And worse, the voice in your head whispers, "Why didn't I sell when I had the chance?" Sound familiar? That sickening whiplash is the exact trap Wall Street counts on you falling into. And I've seen too many good traders, smart, disciplined people, lose everything because they didn't understand one brutal truth. The market doesn't reward intelligence, it punishes psychology. Today, I'm going to show you how to flip that script. You'll learn why most traders never escape the cycle of chasing, panicking, and blowing up accounts, and the few rules that can set you free. We'll dig into the psychology traps that John F. Carter exposed in Mastering the Trade, but through the lens of my own scars, my own research, and the stories of dozens of traders I've mentored. If you've ever wondered why you keep making the same mistakes, even when you know better, then stay with me. Because by the end of this talk, you'll see exactly how to break that loop. So, take a deep breath. You're about to realize that your biggest opponent in trading isn't the market, it's you. And that's why here on Zenstock, we don't just study charts, we study the mind behind the charts. Let me properly introduce myself. My name is Ben, and welcome to Zenstock, where trading meets clarity. Here we focus on mastering your mindset as much as your charts. You'll learn to think differently, manage risk, and trade with calm confidence. Because in the market, your greatest edge is you. This content is for education and entertainment only. It's not financial advice. Always do your own research before trading. Before we dive in, take a deep breath, clear your mind. For the next few minutes, give your trading psychology your full attention. And to show you why this matters, let me share a quick story from my own journey, one that nearly ended my trading career before it ever really began. The first time I came across John F. Carter's book, Mastering the Trade, I wasn't looking for another trading system. I'd already tested 100 setups, indicators, and can't-lose strategies. What I needed was perspective. And what struck me in Carter's writing wasn't the technicals, it was his brutal honesty about psychology. He made it clear that most traders don't fail because they're lazy or stupid. They fail because markets are built to exploit human nature. Overconfidence, fear, the urge to be right. These aren't just mistakes, they're traps designed into the system. That idea hit me hard. Because I wasn't just reading theory, I was seeing my own mistakes on every page. And it reminded me of a painful trade I took years ago, one that nearly convinced me to quit for good. I still remember one of my worst trades, not because of the money, but because of what it revealed about me. It was back in 2018, during the cannabis stock mania. A company called Tilray suddenly became the talk of the trading world. The stock had gone from under $20 to over $300 in what felt like the blink of an eye. Every headline screamed about it. Forums were full of people bragging about doubling and tripling their accounts. I told myself I wouldn't chase. I had rules. I had discipline. But then I pulled up the chart. It looked unstoppable. My plan said, wait. My gut said, this is your shot. And you already know which voice I listened to. The moment I bought, it felt like I was part of history. Within minutes, I was up big, and I couldn't help but think, maybe this is the trade that proves I finally made it. That rush is intoxicating. It's not just profit, it's validation. But the market has a cruel way of humbling you. By the very next day, Tilray collapsed. My screen lit up red. The same people who had been cheering online were suddenly silent. I froze. I told myself it would bounce. I told myself I was smart enough to hold through the storm. But I wasn't thinking, I was rationalizing. Eventually, my stop hit. Not because I honored it, but because the market forced me out. The money I lost hurt, but what stung far worse was realizing how quickly discipline can disappear when emotions take over. That day, I understood something John F. Carter emphasizes in Mastering the Trade. Most traders don't fail because they don't know enough. They fail because their own psychology betrays them at the worst possible moment. And here's the twist. That loss didn't end me. It woke me up. It forced me to see that trading isn't about finding the hot stock. It's about confronting yourself, your impulses, your blind spots, your need to be right. And that brings us to today's topic, because the same traps that caught me in that Tilray trade are catching traders every single day. The difference is whether you spot them or whether they drain your account year after year. What today is really about isn't a single trade. It's about the invisible traps built into the market, traps that feed on fear, greed, and overconfidence. Every losing streak I've ever seen, whether in my own account or in traders I've coached, comes down to the same patterns. The chase for the next hot setup, the refusal to take a small loss, the obsession with being right instead of being profitable. John F. Carter laid this out in Mastering the Trade. He showed that markets don't just punish bad analysis, they punish human nature itself. And the traders who survive aren't the smartest. They're the ones who learn to recognize those traps and sidestep them. That's what we're going to break down today. How to see the patterns that catch most traders. How to separate your identity from your trades. And how to build habits that protect you from yourself. This isn't financial advice. It's education, based on research, experience, and the real-world mistakes of traders just like you and me. And to make it stick, I'm going to give you one simple sentence, a high-level takeaway you can carry into every single trade. If I could boil down years of scars and lessons into one line, it would be this: trading is less like hunting and more like farming. You don't force the harvest. You prepare the soil, plant the seed, and wait for the season. The amateurs chase every move like hunters chasing shadows. The professionals cultivate patience, knowing their edge is in the waiting. That shift in perspective changed everything for me. When I stopped trying to catch every opportunity and started thinking like a farmer, my trading calmed down. My results improved. And most importantly, I stopped needing to be right all the time. Keep that image in your mind as we go forward, because the rest of this talk is about how to build that kind of patience, discipline, and clarity into your daily process. Most traders think markets move because of earnings, headlines, or some secret indicator they haven't bought yet. The harsh truth, price often moves because crowds are predictable. We click the same buttons in the same emotional states, and smart money plans around that. Carter is blunt about this. He explains that markets are structured to exploit human nature. Major intraday and swing moves often launch with the fewest participants on board, which means by the time it feels safe, you're late. When you feel urgency rising in your chest, that's not opportunity, that's bait. This hit me hard because I've watched the same scene play out in dozens of accounts I've reviewed. A trader sits flat all morning, waiting for confirmation. A stock grinds, hesitates, then pops. Chat rooms light up. Our trader jumps. But the pop was the handoff, professionals unloading inventory into eager latecomers. Minutes later, that confirmation reverses and the stop prints at the day's low. The sting doesn't come from the dollars, it comes from feeling played. Here's the pattern beneath that pain, told in but then beats. I had a plan to buy pullbacks in trend, but the move looked too strong to wait. Then I chased a breakout. But momentum stalled immediately, spreads widened, volume thinned. Then I rationalized, it's just a shakeout. But the best entries never made me sweat like this. Then I took a textbook stop, at the exact level everyone else used. It wasn't bad analysis, it was me reacting like the crowd. Why does this happen? Impatience, social proof, and the identity hunger to be in the move. Impatience says, hurry. Social proof says, everyone's doing it. Identity whispers, being in early proves I'm a real trader. Put those together and you've got a reliable liquidity source for the patient side of the tape. Carter's antidote isn't mystical, it's behavioral. He urges you to accept that markets will try to seduce you into late entries, tight stops, and oversized positions, precisely when your dopamine spikes. Once you accept that, your job isn't to predict the next candle, it's to manage your own impulses. The edge isn't the setup. The edge is the state you're in when you execute the setup. An average trader I coached captured this transformation perfectly. He used to chase every midday breakout because he feared missing the big one. We rebuilt his process around two rules. 1. Trade only from plan zones that would feel slightly uncomfortable to buy because they're quiet, not exciting. And 2. If his heart rate jumped, he wasn't allowed to click. In 3 weeks, his win rate barely changed, but his average loss fell by half. He didn't get smarter, he got calmer. Action you can use today. When you feel the urge to chase, say out loud, if this is real, it will give me a second chance. Then mark the nearest level where trapped breakout buyers would puke. often the retest zone you wanted in the first place. If price returns there and your plan remains valid, you act. If it doesn't, you didn't miss your trade, you avoided being someone else's exit liquidity. Hold this frame. Amateurs need excitement to trade, professionals need conditions. If you can sit through the excitement without clicking, you've already stepped onto the pro side of the tape. Once you stop chasing, you meet your next teacher, pain. And if you learn to work with it instead of fleeing it, your trading changes fast. Every trader comes into the game hoping to avoid pain. We want smooth equity curves, stress-free setups, and the fantasy of pulling money out of the market like an ATM. But the truth, the one Carter doesn't sugarcoat, is that pain is unavoidable. The difference between amateurs and professionals is what they do with it. Carter frames it with what he calls the pain principle. The less experience you have, the sharper each losing day feels. Novices suffer deeply because they attach every red trade to their identity. But as experience builds, that pain softens. Pros still lose, but they've learned to process pain as information instead of trauma. I learned this the hard way. Early in my career, a string of losses would wreck my week. I'd sit there replaying charts, feeling like I'd been exposed as a fraud. But the market wasn't punishing me, it was training me. Every sting was feedback. Each loss was tuition, and tuition is never free. I remember mentoring a trader who quit after just 3 months. He couldn't handle seeing red. Every losing trade triggered a spiral. I'm not cut out for this, I'll never figure it out. He wasn't failing because of skill. He was failing because he treated pain as a verdict instead of a signal. Here's the but-then rhythm that plays out in this trap. He wanted growth. But the market gave him losses. Then he interpreted those losses as personal failure. But losses are neutral data, nothing more. Then he quit right before the lessons could compound. The psychological trap here is loss aversion. Behavioral finance studies show that losing $100 hurts about twice as much as winning 100 feels good. This is hardwired. It means your default reaction will always be to avoid pain at all costs, even if the avoidance wrecks your edge. Carter's point is that pros embrace the pain curve instead of fighting it. They expect it, budget for it, and use it to calibrate position size. Pain stops being a verdict when you stop demanding constant comfort from the market. The practical shift. Write down every losing trade, but not in terms of dollars. Document the lesson. Did your entry follow your plan? Did you stick to your stop? Did you size correctly? If the answer is yes, then that red trade is proof of discipline, not failure. That's the reframing most amateurs never make. One of my own turning points came when I forced myself to smile at losses that matched my plan. It felt ridiculous at first. But over time, I realized I was rewarding behavior, not outcomes. The account followed. Once you can accept pain as tuition, the next challenge emerges, resisting the endless search for the perfect indicator or system. That obsession keeps more traders stuck than any losing streak ever will. Every trader goes through it. That stage where you're convinced the missing piece is just one more indicator, one more seminar, one more secret formula away. Carter calls this the search for the Holy Grail phase, and he warns it can trap traders for years, even decades. I've seen this play out more times than I can count. A trader has a rough month, and instead of studying execution or psychology, they binge buy new tools. Moving averages, Fibonacci clusters, order flow dashboards, you name it. Each tool feels like the answer, until it doesn't. The cycle repeats. I fell into this trap myself. After my first losing year, I was convinced I just hadn't found the right system. I bought every trading book I could find, layered indicator on top of indicator, and back-tested setups late into the night. My charts looked like a Christmas tree. And the result? Paralysis. I had so much noise on my screen that I couldn't see a clean setup, even if it smacked me in the face. Carter points out that this obsession isn't development, it's avoidance. Searching for a magic formula feels productive, but really it's an emotional shield. If the system fails, then you didn't fail, the system did. That's comforting, but it stalls growth. One trader I coached had been at it for nearly 8 years without consistency. When I asked him about his strategy, he pulled up a platform with 12 overlapping indicators. He called it confirmation. I called it clutter. He was trying to bury his uncertainty under layers of signals, but all it did was delay decision-making. Once we stripped it down to 2 tools and pure price action, his performance improved, not because of the tools, but because he finally committed to execution. The trap here is outcome confusion. Traders believe the next tool will guarantee results, when in reality consistency comes from habits and discipline. Behavioral research backs this up. In one study of 600 retail traders, over 70% admitted to switching strategies at least once every 3 months. Those traders underperformed the ones who stuck with a simple system and focused on execution. The irony is that some of the best traders Carter knows have used the same setup for decades. They don't need novelty to feel confident. They need clarity. Their edge isn't the indicator, it's the mastery of one repeatable process. The shift is simple but not easy. Stop collecting systems, start mastering one. Take the energy you're spending chasing the next big tool and redirect it toward journaling, self-review, and refining your trade plan. You'll learn more about yourself in 3 months of disciplined execution than in 3 years of system hopping. Trading isn't a treasure hunt, it's craft. And like any craft, mastery comes not from finding the perfect tool, but from using the same tool so well that it feels like an extension of yourself. Carter often says that most of trading is waiting, and when you think about it, that's exactly why it's so hard. We're wired for action, we crave stimulation. Sitting on your hands feels like doing nothing, but in trading, it's the discipline of waiting that separates professionals from amateurs. I had to learn this the hard way. In my early years, if the market opened quiet, I'd force a trade just to feel engaged. My logic was simple: if I'm not trading, I'm not improving. But the result was predictable, small, unnecessary losses that chipped away at my account and my confidence. The truth is, most of those trades weren't part of my plan. They were just me trying to relieve the discomfort of patience. Carter puts it bluntly: amateurs feel the need to be in every move. Professionals wait for their move. Missing trades is part of the business. Chasing trades is how you go out of business. One of the traders I mentored illustrated this perfectly. He would routinely jump into setups halfway through the move. His fear wasn't of losing, it was of missing out. After a month of journaling, he realized something shocking. More than half his losses came from trades that weren't even in his plan. They were impulse clicks. Once he committed to waiting, even if it meant no trade that day, his P&L turned around. The psychological trap here is impatience, tied to FOMO. It feels unbearable to watch a move unfold without you. But here's the truth, there's always another setup. Markets recycle opportunities daily. Missing one trade never killed a career. But overtrading, that ends more accounts than any bear market ever could. Research backs this up. In studies on decision-making under uncertainty, participants who waited for clearer signals consistently outperformed those who acted on partial information. In trading terms, patience doesn't just protect capital, it increases probability. So how do you build patience into your process? Carter recommends committing to just a handful of setups you know cold. For me, that meant 2 plays. If the market didn't show them, I didn't trade. That one boundary kept me from bleeding capital on second-rate opportunities. I also started reframing waiting as part of the job. Instead of telling myself I was doing nothing, I reframed it as scouting conditions. That subtle language shift kept me engaged without needing to click. Patience isn't passive, it's active restraint. And when you master it, you realize something powerful. The market doesn't reward the busiest trader, it rewards the most selective. Once you stop trying to be in every move, you start seeing the few moves worth being in. And that's when your trading begins to feel less like chaos and more like craft. When most people hear risk management, they think spreadsheets, formulas, and cold math. But Carter reframes it. Risk management isn't just about money, it's about emotions. It's about protecting your psychology so you can keep showing up tomorrow with a clear head. Early in my career, I ignored this. I thought bigger size meant faster success. If I had conviction, why not double down? But every oversized position warped my decision-making. I'd stare at the screen, heart pounding, unable to think straight. Even when the trade worked, I wasn't trading well, I was gambling with my sanity. Carter points out that professionals don't blow up because of one bad setup. They blow up because they risked too much on that setup. He urges traders to cut position size until their emotions are manageable. In fact, one of his simplest fixes is this: cut your size in half and double your stop. Immediately, your breathing slows, your patience improves, and you stop micromanaging every tick. I remember working with a trader who consistently nailed direction but still lost money. His problem? He traded size so large that a small dip would shake him out. We ran an experiment. He reduced his size by 70%, widened his stop, and traded the exact same setups. 3 weeks later, he wasn't just profitable, he was calm. His journal entries shifted from panic to clarity. The difference wasn't skill, it was emotional breathing room. The psychology trap here is overconfidence mixed with loss aversion. Traders convince themselves they're sure about a setup, so they load up. But once they're in, the fear of losing that oversized stake magnifies every tick against them. Instead of trading the plan, they trade their P&L. Behavioral finance studies confirm this spiral. In one experiment, participants who risked a larger portion of their stake became more loss-averse and more irrational with each setback. They averaged worse results than those who played smaller but stayed consistent. Here's the shift. Think of risk management, not as limiting upside, but as buying emotional insurance. Every time you keep risk small, you're paying for the ability to stay rational. And rationality is where your edge lives. For me, the turning point came when I started defining risk not just in dollars, but in sleep. If a position was so big that it made me check my phone at night, it was too big. My rule became simple. Size so that a stop out stings, but never so much that it shakes my identity. Carter's approach echoes this. He stresses that your first job isn't to make money, it's to protect capital. Because once capital is gone, so is your ability to trade tomorrow. Risk management isn't a constraint, it's freedom. And once you see it that way, you realize consistency doesn't come from finding better trades. It comes from building a process that keeps you sane enough to execute them. If there's one trap that destroys more traders than any other, it's the identity trap, the need to be right. Carter highlights this over and over. Traders lose not because they lack setups, but because they confuse their identity with their trades. They cling to losing positions just to avoid admitting they were wrong. I've been there. Years ago, I shorted a mid-cap tech stock that had been running hot. My analysis was solid. Valuation was stretched, momentum indicators were screaming, and for a few hours it looked brilliant, price dipped and I felt vindicated. But then it reversed. My stop was clear, but I couldn't bring myself to take it. Selling would mean I was wrong. I told myself stories, it's just shaking out weak hands. The fundamentals will win. Each rationalization dug me deeper. By the time I finally cut, the loss was triple what it should have been. Carter warns that this pattern is lethal because markets reward it just often enough to reinforce the behavior. Sometimes a loser does bounce back. That relief rally teaches you the wrong lesson, that holding is strength. The next time, you hold longer. Eventually, the market doesn't forgive, and your account pays the price. One trader I coached lived in this cycle. Every blown stop was a narrative. Market makers hunting liquidity, they were shaking out retail, or news headlines sabotaged him. In his journal, every loss had an external excuse. The breakthrough came when I asked him to write one line after each trade, what part of this loss was my fault. At first, he resisted, but gradually his entries changed. I oversized, I moved my stop, I rationalized. That shift from blame to ownership was the beginning of his consistency. The psychological traps here are ego and confirmation bias. Ego says, if I'm wrong, I'm worthless. Confirmation bias filters every tick through the lens of your original thesis, blinding you to evidence that you should exit. Together, they keep traders married to losers long after the divorce papers should have been signed. Behavioral finance research supports this. In one classic study, investors held losing stocks nearly twice as long as winners. Why? Because realizing a loss felt like admitting personal failure. This disposition effect is universal, and it costs portfolios dearly. The antidote is separating self-worth from outcomes. Carter drives this home. Your job isn't to be right, it's to trade well. A stop out isn't an insult, it's proof you followed risk rules. When you can see yourself as a risk manager instead of a fortune teller, the need to be right fades. One simple tool: rename your stop orders protection orders. That's what they are. They protect your account and your clarity. When you hit one, thank it. It did its job. Trading becomes lighter when you realize your identity doesn't sit in any single trade. Your worth isn't tied to a chart. And once you can let go of being right, you unlock the freedom to finally trade with calm. Up to this point, we've looked at trading through stories, mine, Carter's, and those of the average traders I've coached. But the beauty of trading psychology is that it's not just anecdotal. It's measurable. Behavioral finance has spent decades proving what every trader learns the hard way. Take overconfidence. In one large-scale study of more than 10,000 brokerage accounts, researchers found that the most active traders, the ones most confident in their edge, actually earned the lowest returns. Why? Their belief in control blinded them to randomness. Carter's warning that the market punishes psychology, not intelligence, comes alive here. Smart people don't underperform because they lack knowledge. They underperform because they overestimate their control. Or look at loss aversion. Kahneman and Tversky's famous prospect theory experiments showed that the pain of losing $100 is about twice as powerful as the joy of gaining it. Translate that into trading. Every small red trade feels heavier than an equal-sized win. That explains why beginners move stops, hold losers, and sabotage discipline. Carter's pain principle isn't just a metaphor, it's a reflection of our neurological wiring. Another study tracked 600 traders across a year. Those who switched strategies frequently, chasing the Holy Grail, performed significantly worse than those who stuck with one simple approach. The worst performers had jumped strategies at least 4 times in 12 months. The best? They refined a single playbook, exactly as Carter advises when he warns against indicator addiction. Even patience has been tested. A Stanford experiment on delayed gratification, the famous marshmallow test, found that children who resisted immediate temptation scored higher on life outcomes decades later. In markets, the parallel is clear. Those who can wait for their setup, even when noise tempts them, tend to outperform. Carter's advice that most of trading is waiting echoes this timeless principle. And let's not forget the social side. Herd mentality is one of the most consistent drivers of bubbles and crashes. From tulips to dot-coms to meme stocks, history shows that once the crowd piles in, risk doesn't decrease, it skyrockets. Carter reminds us that professionals profit not by joining the stampede, but by anticipating when the herd will be fleeced. When you line up the evidence, the picture is undeniable. Markets aren't a puzzle to solve. They're a mirror that reflects our biases back at us. Carter wasn't exaggerating when he said the market preys on human nature. Study after study confirms it. Our wiring is the biggest risk on the trading floor. The good news? Awareness is power. When you know the biases, you can guard against them. When you understand the traps, you can sidestep them. Trading psychology stops being a vague concept and becomes your sharpest weapon. And once you see it, you can't unsee it. That's when your journey shifts from being prey to finally playing the game on your own terms. Every trader knows the technical errors, chasing, poor stop placement, oversized positions. But beneath those mistakes are deeper psychological traps. Carter highlights them, and I've seen them firsthand in every blown-up account. Let's break down 3 of the most destructive. 1. Overtrading from impatience. This is the silent account killer. A trader thinks, if I'm not in a position, I'm not progressing. So they click, again and again. Carter warns that amateurs believe they have to be in every move, while professionals wait for their setup. The trap is mistaking activity for progress. In reality, progress comes from restraint. One of my students cut his trades by 60% and immediately saw his P&L improve, not because he got smarter, but because he stopped bleeding capital on noise. 2. Loss aversion, leading to stop sabotage. Every new trader knows the temptation. You set a stop, price drifts toward it, your chest tightens. Maybe I'll just move it a little further. Before long, a manageable loss snowballs into a nightmare. Carter is clear. Refusing to take a loss destroys confidence faster than anything else. Behavioral research confirms this. Humans hate realizing a loss so much that we'll distort reality to avoid it. The fix? Treat stops as protection, not punishment. When they hit, they're saving your capital, not condemning you. 3. Confirmation bias. Carter notes that markets aren't irrational. We are. Once you've decided on a trade, your brain filters every tick to confirm your view. You ignore signals against you and cling to the ones in your favor. I've watched traders cheer a weak bounce while dismissing the avalanche of volume pushing against them. Confirmation bias makes you double down on losers and bail too early on winners. The way out? Force yourself to write both sides of the argument before entering. If you can't state clearly why the other side might be right, you're walking blind. Each of these traps looks different on the surface, but they all come from the same place: emotion hijacking process. Carter's message is simple. The market doesn't punish your knowledge, it punishes your psychology. Recognize the trap, and you've already taken its power away. Stories and psychology matter, but without tools you can apply today, they're just theory. Carter is clear about this. Traders need rules to anchor them when emotions spike. Here are 2 practical frameworks that have changed the way I trade and the way I coach others. 1. Cut size, double stops. Carter suggests one of the simplest fixes in trading: cut your position size in half and double your stop. At first it sounds counterintuitive, but here's why it works. Smaller size reduces emotional pressure. A wider stop takes you out of the noise. Together, they give your trade room to breathe. One trader I worked with used this rule for just a month and reported something remarkable. Not only did his losses shrink, but his stress level did too. He wasn't glued to the screen anymore. He let the trade work. 2. Plateau money management. Carter also emphasizes the importance of protecting gains. One method is the plateau approach. Once you hit a certain profit milestone, you reduce size or lock in part of your winnings before pushing forward. It's like building a financial staircase. Each plateau becomes a safety net that keeps you from giving back months of progress on one bad streak. These tools don't just guard your account, they protect your psychology. And protecting your psychology is how you stay in this game long enough to actually master it. Let's pause here, because none of this matters if you don't apply it to yourself. Ask yourself honestly, are you trading to be right or to make money? Do you treat losses as tuition or as proof that you're not good enough? When you look at your last 10 trades, how many were truly from your plan and how many were impulse clicks? And maybe the hardest question, if someone else reviewed your trading journal, would they see discipline or chaos? Carter's work makes it clear that the difference between amateurs and professionals isn't IQ. It isn't who has the best indicator package, it's who tells themselves the truth. I'll tell you what I ask every trader I work with. What are you hiding from yourself? Because until you bring that into the light, no strategy in the world will save you. Take a minute after this video, write down your answers. Don't filter, don't rationalize, just write. Because the fastest way to grow in trading isn't by finding a new setup, it's by being brutally honest about the one person you can control, yourself. If you've stayed with me this far, you already know the truth. The biggest edge in trading isn't a secret setup, it's mastering your own psychology. Carter showed it, my experience confirms it, and now it's in your hands. So here's my challenge to you. Write in the comments the one lesson from this video that hit you hardest. Share this with a friend who might be struggling, someone who keeps making the same mistakes and needs to hear that they're not alone. And if this resonated, hit like and subscribe so we can keep building a community of traders who are serious about mastering both charts and mindset. Trading doesn't have to feel like chaos. It doesn't have to be an endless loop of hope and regret. With the right mindset, rules, and self-honesty, you can trade with clarity, master your mind, master the market. Trade with confidence and live with calm.